Okay, greetings everyone. Let me try to take on another question that was sent to me the other day. And it is this one here regarding asset allocation. Now, you might need to pause your machine in order to read in more detail. If you wish to do so, you can do that now. The question basically is regarding the relative importance of asset allocation versus stock picking. And in the class, Professor Fong was saying that asset allocation is more important for a number of reasons, including the fact that stocks tend to move in the same direction in the end. So common stocks, performances of common stocks tend to move together. Therefore, the aggregate impact of a common stock or a handful of stocks will not be substantial. And the question is, I have no problem following the conclusion, but I find the assumption that the performance of common stocks tend to converge a little bit difficult to appreciate. I'm wondering if you can elaborate on this a little bit. It's an interesting question, and I think there are a number of things you can say about it. Let me first of all try to play a video that I found, which is really pretty simple stuff. So this is trying to explain. The question is exactly that. Why do all stock prices tend to move in the same direction? And he's explaining in a very, very simplistic manner. So let's just start with that. Okay.
Why does every company's stock price tend to move in the same direction?
Stock prices tend to move in the same direction, which we call being highly correlated, because the economy as a whole ends up moving up and down. So when people are happy and they're getting raises and their houses are going up in value, then they have more discretionary income, they're buying more products, and companies are selling more products. When there's a recession and people are having their houses foreclosed and people are losing their jobs, then they're not buying as much and they're trimming back on all of their discretionary purchases, and so all the companies are not making as much money. It's probably about 75 to 80% of the U.S. economy is discretionary spending, and so that drives most of the markets. Now, there's a few kinds of industries that generally don't move in sync with the rest of the U.S. markets. They're often the ones in the hard asset category.
Okay, now this is a fairly simplistic explanation that everyone can sort of try to understand. Now there are, I think, more vigorous ways that you can try to handle this. So don't forget, if you were to just refer to the capital asset pricing model, if you were to do that, then the return of any stock would be the risk-free rate multiplied by the beta of that stock. Added to the beta of that stock multiplied by the market risk premium. Now, this is a well-known capital asset pricing model. Okay, if you assume this to be valid, then it should be absolutely obvious that as the market goes up, as long as your beta was positive, your stock also goes up. So you could argue just from this simple formula that stocks in the end have a tendency to move in the same direction, even though they may not do so by the same amount. Okay. Now, I think maybe it's helpful if I try to approach this question from a slightly different angle. You have to take a step back and try to understand what really happens, in the funds management industry, at least for mutual funds and traditional classical sort of CFA type domain, or the Fidelities and the PIMCOs and the Templetons of this world. what they actually do. Now, these companies, of course, if you have money, you could go to them and say, I'd like to invest in your, XYZ bond fund, or your ABC stock fund, your Asian emerging market, equity fund, or whatever. You could also, there is a class of products out there, and they're called balanced funds. Now, what a balanced fund is, if you invest in a balanced fund, then basically within this fund there would be a number of asset classes. So let's make it real simple. So let's say there's some equity, okay, and they'll tell you that when you go in, and there'll be some bonds, and then there might be some cash, okay. And now here, individual companies like Fidelity or State Street or whatever would have some freedom as to how they allocate their money. So one company might allocate, let's say, 60% to stocks, and then maybe 30% to bonds, and 10% to cash. Now that's expressing it in a very simplistic way. Maybe another company is very, very positive. So this is company A, and then maybe company B is very, very positive on the stock market, and then they allocate, let's say, 75% to stocks, and then maybe 20% to bonds, and 5% to cash, whatever. Okay, and you can see that, let's just say that 1 year later, if the overall market, if the overall stock market, if the market was to go up 15%, which it sometimes can do, okay, then what would happen is, for portfolio A, the contribution from the equity side would be 9% of the whole portfolio, because 15% times 60% is 9%. Okay, whereas for this one, it would be close to what, 3.75, 12.25, I think. Okay, so you can see immediately that just by making a different asset allocation judgment, traditionally asset allocation accounts for far more of your performance. It is true. I mean, numerically, it has to be true. If you get your asset allocation right, so what I mean by that is, if you feel that the stock market will have a good year and you overweight relative to your peers, that's what I mean by getting it right. Or you go underweight when you feel that the market is headed for a downturn. If you get that right, you will make, the bulk of your performance will come from there. Now, it is of course possible that within your portfolio, there are some, now you're down to the individual stocks, and you can have hundreds of stocks, okay, and some of these may indeed outperform. That's the first point. They may indeed outperform, but it's a little bit like, you go to war, and there are different battles to like World War II. There's Battle of Normandy, there's Battle of the Somme, and there's Battle of Britain or whatever. Okay, so each asset class is a battle on its own. Now, when you fight a battle, you have to be very strategic, but battles are very, very rarely won because of some very outstanding foot soldiers turning the whole thing around. Sometimes it can happen, individual soldiers became the decisive factor, but normally that is not the case. Okay, so you have to be very strategic about the whole thing. So this is kind of the same. Okay, so if you get your asset allocation decision right, it ends up affecting all your stocks. Whereas, for an individual stock to outperform, well, I mean, look, it depends on the reason that your stock is outperforming. So typically, there can be three drivers, if you like, if you look at it, in practice. So either the whole market is going up, and then you've got this CAPM thing and the video I just showed you to think about, or maybe there's something special about your industry. Maybe you are thinking about solar power, and suddenly the whole world, all the governments decided to cut back on carbon emission and focus on solar power. So the solar power industry would have a good day, good year. But then most, perhaps all solar power industry companies will go up. Now, the third factor, of course, is if there's something special about a particular company, which is sometimes called idiosyncratic. If there's something of an idiosyncratic character happening to a particular firm, maybe an oil or gold mining company, and they just suddenly discover this huge gold mine in the middle of nowhere, and it's only applicable to that company. Now that can also happen, but overall, I think it depends on what is driving the rise in price. So even if there is nothing special happening to a company, it is true that that the market itself, if the economy was moving in a certain direction, there's a saying in English, a rising tide, oh, it's so hard to write here. I'm writing on a electronic tablet board. A rising tide floats, all boats, something like that. Okay, so to a certain extent, it is true. So asset allocation certainly is a very important process. Now, and I think to some degree, it is true that stocks tend to move in the same direction. They don't always do, by the way. So on any given day when the stock market is up, so when you hear on the radio that the S&P 500 went up 1%, if you were to look deeper into all the 500 members of S&P 500, do you think they all went up that day? No, of course not. It could be that 75% of the stocks went up. So 350 stocks went up or whatever, and 150 stocks actually went down. Okay, but overall, more stocks went up than stocks that went down. It could even be 50-50, but because the stocks that went up were bigger companies in terms of market weight, so overall the index went up, even though in terms of number of companies, half of them did not participate in the rally. Now, this kind of analysis actually is called market breadth, and it is, for those of you who are interested in technical analysis, BREADTH. Okay, it's a measure of how many companies went up relative to how many companies went down. In terms of an index portfolio, you can have exactly the same amount of percentage gains, but the number of companies that went up versus companies who went down can be very, very different. You could even have a minority of companies going up, a majority is going down. But if these are big companies, okay, then that would tend to pull the index up, and this is known as market breadth analysis. It's trying to tell you something about the overall market and what's really going on and what is driving the market direction and so on. Now regarding asset allocation, and I guess I'm kind of getting on to question number 2. Now Professor Fang, it's Professor Fong, by the way, F-O-N-G, also mentioned different types of investors. Momentum, contrary, may have impact on the decision making as to whether to change the weighting of the composite stocks in the portfolio, even when a portfolio per se has been value weighted. Can you elaborate on this? Yes, I can. Now, if you look back at the diagram I was drawing previously, now let's say you chose company fund manager B, and they had 75% of their weights in equity, and if stock prices keep going up, then one period later the value of your stocks may well become a much actually a bigger percentage of the overall balanced fund portfolio. Let me see if I can move to another page. Hold on a second. Okay, so I'm going to move to a new page. So let's just say that one period later for portfolio B, because of the so let's just say that one period later, so your portfolio now, because of the rise in the stock price, it's now 80% in equity, so it's fairly overweight, and maybe the bonds are now only like 12%. Okay, and so the balance is cash, something like that. Okay, now the question now is, well, if you're the portfolio manager, what do you do? Now there are two things you can do. You can just leave it the way it is, okay, or maybe you try to sell off. Well, there are actually three things you can do. Okay, so either you do nothing, you just leave it and let it run, or you try to sell off a portion. So maybe you sell off some of the stocks and you will either buy bonds or you just put it in cash. Now there is actually even something you can do. Maybe the other way is you take some of the cash and you buy even more. Okay, you get even more overweight. And what really drives a decision like that? Now this process is dynamic, so it's not like on the 1st of January you do your asset allocation and okay, I'm going to see you in Christmas. It's not like that. So it's dynamic, and every day you come to the office, you are thinking about it. So you can do one of those three things. So either you do nothing, okay, just let it run, or you try to sell and rebalance, okay, or you might buy some more. Now, if you're already 80% in equity and you want to buy some more, maybe it seems a little bit extreme, but you know, that's not the point. The point is, do you want to go for even more exposure or not? And what would drive this decision would be, according to the question, whether you are a momentum guy or a contrarian kind of investor. What is the difference? If you are contrarian, then as markets go up, generally you are doubtful that it can keep going up, or you are more cautious that, as markets go up, there is a chance that you can get a correction. So you probably will sell, okay? But if you are a momentum guy, you do exactly the opposite. So as markets go up, you think, oh wow, okay, I think there is momentum here. It's going to keep doing that, okay? And I'm going to buy some more as a result. Now, as to the question of which one is more, more appropriate, that's an entirely different discussion that can take up, half a course in investing and portfolio management. But I just draw your attention to the different investment styles, namely momentum versus contrarian. Okay, so that would be the reason why they are rebalancing up or down, according to their style and how they try to track the market. Okay, I hope this is helpful. Thank you very much. Thank you. Bye bye.